Welcome to the research desk.
Yes, and today we're looking at something that honestly humbles the most sophisticated mathematical minds in the industry.
Exactly. We're examining a paradox at the very heart of quantitative portfolio management, because the central, unavoidable truth of institutional finance is that leverage, not direction, is what kills sophisticated investors.
Right. You can be entirely correct about the underlying fundamentals of an asset, you know?
Oh, absolutely. You can perfectly predict the macroeconomic environment. You can identify a profound mispricing in the market. But if your sizing is miscalibrated when the environment fundamentally changes,
You'll be carried out on a stretcher.
yeah, you will go bankrupt while being absolutely right. Which brings us to the core tension we're dissecting today. We are looking at regime detection models.
The famous, or maybe infamous, mathematical frameworks designed to map the shifting states of the market.
Right, and the big question is, do these models actually save investors by forcing early disciplined de-risking? Do they act as an unemotional safeguard that cuts your exposure before a localized fire becomes a systemic inferno?
Or, and this is where I stand, do they ultimately destroy investors? Do they create this illusion of false precision and encourage catastrophic, mathematically justified leverage into fundamentally unstable markets?
Well, to ground this, we really need to look at the foundational empirical evidence. We have a three-stage Gaussian hidden Markov model, frequently referred to as an M.
And this specific model has been fitted to 15 years of daily returns on the SPY, right? The ETF tracking the S&P 500.
Exactly. But before we look at the outputs, we have to understand what a hidden Markov model actually is. It assumes that the market is driven by latent, invisible states.
Latent meaning you can't observe the state directly.
Right, you can only observe the emissions of that state. In this case, daily price returns and market volatility. Think of it like being locked in a windowless room, trying to determine the weather outside.
You can't see the sky.
No, you can't. But you can watch the people walking into your office. If they're carrying dripping wet umbrellas and wearing heavy raincoats, you infer with high probability that it is raining.
Sure, and if they walk in wearing sunglasses and carrying iced coffee, you infer it's sunny.
Exactly. The weather is the hidden state. The umbrellas and sunglasses are the observable data. So in financial markets, the hidden Markov model looks at the observable data of returns and volatility, and it categorizes the market into three distinct risk buckets. Let's walk through them.
Let's hear it.
First, we have the bull regime. In this state, the market delivers a positive 28.5% annualized return. Crucially, it does so with a deeply subdued 9.9% volatility.
So a very low-stress, high-reward environment.
Yes. The average duration of this state is 44 trading days, and the market spends the vast majority of its time, about 68% of the 15-year sample, comfortably residing here. This is the sunny day.
Okay, but then the weather changes.
Right. Then conditions shift into the flat regime. The drift turns negative, delivering a minus 10.7% annualized return. At the same time, volatility more than doubles to 21.9%.
So the market is chopping sideways with a downward bias, and the daily price swings are widening.
Exactly. This state lasts an average of 20 days. This is the storm gathering. And finally, we have the bear regime. The numbers here are extraordinarily violent.
They really are.
We see a minus 14.7% annualized return alongside an explosive 69.9% volatility. This state is a flash crash in slow motion. It lasts an average of just 10 days and occupies only 1.2% of the total time in our 15-year sample.
Just 1.2%? Keep that in mind, folks.
I will, but my position on this data is firm. I champion this regime sizing framework as the definitive missing edge in quantitative portfolio management.
A definitive edge? Really?
Yes, financial markets are infinitely complex, generating an overwhelming barrage of noise. This model compresses that changing return distribution into a highly actionable mathematical risk map. It prevents overbetting by objectively and coldly identifying when the market is no longer hospitable to your capital.
And I look at those exact same parameters. I look at that exact same elegant categorization of market weather, and I see a framework that is terrifyingly fragile.
Fragile? How so?
Well, I look at this model and I see a veneer of mathematical elegance that masks a profound, potentially terminal structural danger. You describe this as a definitive edge. I describe it as a sophisticated trap.
A trap?
Absolutely. The fatal flaw of this entire framework lies in its foundational assumptions, specifically the assumption of stationarity and the reliance on Gaussian distributions to model extreme market stress.
But the model clearly adapts to stress.
Wait, hear me out. Financial markets do not obey neat, static parameters over time. A 15-year sample is a grain of sand in the broader macroeconomic history of human commerce. When you take a rigidly fitted historical model and you apply it to real-world exogenous shocks, the kinds of shocks that actually destroy capital, it ceases to be a risk management tool.
I completely disagree that it ceases to manage risk.
It doesn't manage risk. Instead, the illusion of precision it provides acts as an extinction event. It gives the quantitative portfolio manager the mathematical confidence to apply maximum, highly levered exposure right at the precipice of a structural break.
But the market isn't just randomly breaking all the time.
No, but the market is not a physical system with immutable laws. The gravity in finance can reverse overnight. And when a regime model encounters a market reality it hasn't been programmed to recognize, the leverage it commands does not save you. It accelerates your demise.
Okay, well, to understand why this framework is so seductive to institutional capital, we have to look past the theoretical friction you're talking about and examine the raw, empirical outcomes it produces when applied systematically.
Let's look at the back test.
Sure.
We need to look at what happens when you build a trading apparatus around this exact three-state model. Let's construct a theoretical strategy based on the model's outputs. The rules are simple.
Go on.
When the hidden Markov model detects we are in the bull regime, we go long the SPY. When the model infers we have entered the bear regime, we short the SPY.
And the flat regime? When the model detects the flat regime, that high volatility, negative drift environment, we exit the market entirely and strictly hold cash.
Okay, cash in the flat regime.
Right. The results of this systematic application are staggering. Over the pristine 15-year sample, this dynamic strategy delivered a positive 21.9% compound annual growth rate.
Which is massive.
It is. But institutional allocators don't just look at raw returns. They look at risk-adjusted returns. They look at the path dependency of that capital. This strategy generated a Sharpe ratio of 1.68.
Yeah, and in the world of long-only equities, a Sharpe ratio above 1.0 is exceptional.
Exactly. A Sharpe of 1.68 is the kind of performance that allows a fund to raise billions of dollars overnight, and crucially, the strategy restricted its maximum drawdown to only minus 20.4%.
Compared to what exactly?
Compare that dynamic, regime-aware approach to a standard, passive buy-and-hold approach over the exact same 15-year period. The buy-and-hold investor yielded a 12.9% CAGR. Respectable, certainly.
But much lower Sharpe, I assume.
Yes, they achieved a Sharpe ratio of only 0.70. And more importantly, to earn that 12.9%, the buy-and-hold investor was forced to suffer through a devastating minus 33.7% maximum drawdown.
They had to watch a third of their wealth evaporate.
Right, and simply hold on, hoping the macroeconomic environment would eventually stabilize. But the most revealing metric, the data point that truly proves the primacy of the regime, comes from what happens when you decide to fight the state.
You mean inverting the signals?
Exactly. What happens if we mirror image the strategy? What if we short the bull regime, go long the bear regime, and hold cash in the flat regime?
I imagine it's pretty brutal.
It is complete, irrecoverable annihilation. A portfolio executing that inverse strategy generates a minus 19.1% CAGR. It produces a disastrous minus 1.80 Sharpe ratio.
Wow.
And it suffers a devastating minus 95.9% maximum drawdown. It essentially goes to zero.
That's a total wipeout.
It is. And the reason fighting the state destroys capital so absolutely is the overwhelming persistence of the regimes. When we analyze the Markov transition matrix, we find that the daily persistence of the prevailing regime is a staggering 95.5%.
95.5%.
Right. That means if the market opens in the bull regime today, there is a 95.5% mathematical probability it will remain in the bull regime tomorrow. At a daily horizon, momentum utterly dominates the structural mechanics of the market.
So you're saying the ecosystem is heavily state dependent.
Highly state dependent. Ignoring this daily state dependence isn't just a difference in investment philosophy, it is mathematically irresponsible.
Okay, but let's pause right there. So what actually happens when we zoom out just slightly? Think about this for a second. We have a daily persistence of 95.5%. At that microscopic resolution, sure, the model looks like a flawless crystal ball for short-term momentum.
It acts like an impenetrable armor against market forces.
But financial realities are not confined to a 24-hour loop. Portfolio managers don't live exclusively in the space of a single trading session. We have to look at how this mathematical persistence behaves across time.
The horizon matters, yes.
It matters entirely. Because at the weekly horizon, that commanding 95.5% persistence collapses to 54.5%. Let that number sink in.
It's a drop, certainly.
It's a massive drop. Over the course of just 5 trading days, your 95% certainty drops to a level that barely edges out a coin flip, and it gets exponentially worse.
You're talking about the monthly time frame?
Yes, at the monthly horizon, the persistence plummets to 44.8%. At that frequency, the momentum effect hasn't just degraded, it has entirely vanished. In fact, at 44.8%, the market is actively pushing against you. Mean reversion begins to aggressively take over.
But the model is recalculating daily, so it adapts before the month is out.
But this frequency shock, this violent decay of persistence as you extend the timeline, exposes the profound structural instability of the entire framework. A model fitted to a pristine 15-year sample is nothing more than a parsimonious description of the past.
It's a reflection of consistent market mechanics.
No, it is an intricate, highly polished mirror reflecting data that has already occurred. It is not an enduring ontology of the market. The edge you are describing degrades violently depending on your operational horizon.
Which is why you size the positions dynamically.
But this is the critical vulnerability. Structural instability, or what statisticians call non-stationarity, the fundamental generating process of the market, the underlying machinery that creates returns and volatility, is constantly changing.
Of course it changes, but the states capture those changes.
They capture the past changes. The market of 2010 is not the market of 2020. Regulatory frameworks shift, central bank liquidity mechanics evolve. The dominance of passive indexing alters price discovery entirely.
And the emissions of the pick up on those shifts.
Eventually, maybe. But if an investor builds an entire risk infrastructure, allocating billions of dollars in leverage, assuming that a daily persistence metric guarantees safety, they are entirely blind to the non-stationarity of the market.
They aren't blind, they are reacting to the math.
The generating process mutates, and when it does, the model's parameters become instantly obsolete. You are driving a car at 200 miles an hour while looking exclusively in the rearview mirror, confident the road is straight simply because it was straight 10 seconds ago.
Which brings us directly to the sizing engine, where the mathematical imperative of the framework becomes clear, and where we address your concerns about application.
Sizing is where the real danger lies.
Detecting a regime is only half the battle. Staring at the weather outside is useless unless you change your behavior based on what you see. How you size your exposure based on that detected regime is where the edge is actually monetized.
Right.
To determine sizing, quantitative managers apply the Kelly framework.
For those who might not know, John Kelly was a researcher at Bell Labs in the 1950s, right? Working on signal noise in long-distance telephone lines.
Exactly. And his equations were later adapted into a universal sizing algorithm for investing and gambling. The Kelly criterion is beautifully simple in its logic, even if the math can become complex. It defines the optimal fraction of your capital to risk as your expected edge divided by the variance of the asset.
Your edge being your expected return and the variance being your risk.
Correct, because we have mathematically proven through the 15-year sample that both expected return and variance are wildly different depending on the hidden state. It is an absolute certainty that your position sizing must be regime-dependent as well.
You can't bet the same amount in a storm as you do on a sunny day. I agree with that principle.
The raw Kelly outputs derived from the model's state-conditioned estimates are highly instructive here. Let's look at the math. In the bull regime, that low volatility, high return environment where the drift is positive 28.5% and volatility is a subdued 9.9%, the Kelly formula demands immense exposure.
What kind of exposure are we talking about?
Because the variance is so low and the edge is so consistent, full Kelly implies roughly 29x leverage.
29 times.
Yes, 29x. It is telling the manager to borrow massive amounts of capital to maximize the harvest of this highly stable environment. Then, conditions deteriorate into the flat regime. Volatility doubles. Drift turns negative. The edge evaporates.
So the size drops.
The Kelly output instantly adapts, dictating negative 2.2x exposure. It commands the manager to short the market with leverage.
Okay, and the bear regime?
Finally, the violent bear regime arrives. Volatility explodes to 69.9%. The annualized return plunges to minus 148.7%. The Kelly output responds to this severe downward drift by calling for negative 3.0x exposure.
Negative 3 times leverage in a 70% volatility environment.
Now, whether a portfolio manager actually levers up a portfolio 29 times is beside the point. No institutional risk committee would allow 29x leverage on an equity index. The raw numbers are theoretical limits.
I would hope they're theoretical.
But even if 29x is practically extreme and operationally capped at, say, 2x or 3x, the massive directional flip proves the central premise. The exact same underlying asset, the SPY, demands radically different sizing across different states.
Right.
The risk-reward profile morphs entirely. To hold a static position size, to blindly hold one unit of risk across a dynamically shifting market ecosystem is the true failure of logic.
Let's dwell on those numbers for a moment, because they are not just theoretical limits. They are the precise mechanism of ruin. They are the trap I am warning about.
You're overstating the danger of a mathematical output.
Am I? 29 times leverage in the bull regime, negative 3 times leverage in the bear regime. Consider the terrifying fragility of that bear estimate.
The estimate is based on the data.
We are talking about commanding a heavily leveraged short position, negative 3.x, in the most volatile, unpredictable environment imaginable. The model indicates that the bear regime occurred only 1.2% of the time during the entire 15-year sample.
Yes, it's rare.
It lasted an average of just 10 days per occurrence. We're looking at an incredibly brief, highly compressed temporal window. And yet, based on that microscopic sliver of historical data, the Kelly equation is deriving a highly precise, structurally critical sizing parameter.
It's optimizing for the observed conditions.
It is telling you to bet 3 times your net worth against the market based on an isolated, sparse cluster of 10-day historical events. This is the extinction event analogy realized. Let me explain exactly why.
Go ahead.
The Kelly criterion is a brilliant mathematical formula, but it is absolutely merciless to estimation error. Kelly assumes you know the true probabilities of the game. If you're counting cards in blackjack, you know exactly how many aces are left in the deck.
The math is finite, yes.
The denominator is fixed. But in financial markets, you never know the true probabilities. You only have estimates based on the past. If your inputs to the Kelly formula are wrong, Kelly will accelerate your demise faster than any other sizing algorithm ever created.
If the inputs are wrong, sure.
It will force you to overbet your capital right into a buzzsaw. And the inputs are almost guaranteed to be wrong. Why? Because the hidden Markov model we are discussing uses Gaussian emissions.
Which is standard for this type of quantitative modeling.
It assumes that market returns follow a normal distribution, the classic bell curve. In a bell curve, extreme events, the so-called tail events, are statistically nearly impossible. A 5 standard deviation move in a purely Gaussian framework should happen once every several thousand years.
We know markets have fat tails, but the model...
We know with absolute empirical certainty that financial market returns are not Gaussian. They are deeply fat-tailed. They are heavily skewed. 5 standard deviation moves happen every decade, and they happen exactly when stress periods hit.
Which is why the model has a bear state.
But the bear regime is the precise environment where the bell curve breaks. Stress periods are where Gaussian assumptions fail hardest. So follow the logic of the trap. Your model assumes a bell curve, therefore your model fundamentally underestimates the likelihood of extreme volatility.
The variance captures the volatility.
Because it understates the volatility, the variance, which is the denominator in the Kelly equation. The Kelly formula artificially inflates your optimal bet size. If your model understates the volatility of a tail event by even a fraction, and you apply negative 3.0x leverage based on that understated risk, you are holding an engraved invitation to ruin.
That's a dramatic way to look at a statistical outlier.
You are scaling up your exposure, borrowing money, and shorting the market aggressively into a fundamentally mismeasured tail event. When the market rips upward in a violent short squeeze, because bear markets are notorious for the sharpest, most aggressive bear market rallies in history, your negative 3 times leverage will vaporize your portfolio before the model can even register a regime change.
Well, you are focusing entirely on the extreme endpoints of the distribution, isolating the absolute peak of the bull and the deepest abyss of the bear. But the true operational power of this model, the mechanism that actually protects capital, lies in the transitions between those states.
Transitions can be just as dangerous.
To understand how the framework saves investors, we must examine the hidden Markov Models transition matrix. The transition matrix is a grid of probabilities that dictates how likely the market is to move from one state to another on any given day.
And what does it say?
There is one statistic in this matrix that is more fascinating and more consequential than any other. The probability of transitioning directly from the bull regime to the bear regime is exactly 0.0%.
0.0%.
Yes, according to the historical data, the market simply does not snap from absolute tranquility to maximum violence overnight. The probability of transitioning from the bull regime to the flat regime, however, is 2.3%.
Okay, so it steps down first.
This introduces the critical concept of the waiting room. Financial markets almost never go from absolute euphoria to systemic ruin in a single uninterrupted step. It's not a light switch.
But sometimes it is.
Rarely. The deterioration of a market manifests first as a loss of trend quality. It shows up as narrowing market breadth, where fewer and fewer stocks are carrying the index higher. It shows up as a subtle but persistent rise in underlying volatility. The daily ranges expand, the intraday reversals become sharper.
Right, the early warning signs.
This environment is the flat regime. It is the waiting room. It is the buffer zone between prosperity and catastrophe. We can see this perfectly mapped in the historical case study of the dot-com unwind from 2000 to 2002.
That was a very specific type of unwind, though.
But if we look back at that era, the mania didn't end overnight. It wasn't a sudden, unforeseen lightning strike. It was a slow-motion unraveling. Throughout late 1999 and early 2000, valuations stretched to fundamental breaking points. Market leadership narrowed dramatically to a handful of massive tech and telecommunications names.
True.
And crucially, volatility began to steadily rise even while the broader indices stalled or pushed for marginal new highs. The hidden Markov model, analyzing that data in real time, didn't need to be a perfect oracle. It didn't need to predict the exact day the Nasdaq would peak in March of 2000.
It just needed to see the volatility.
It simply needed to recognize the warning zone. By identifying the shift out of the low volatility bull state and into the high volatility negative drift flat regime, the model mandates a massive reduction in exposure.
So you go to cash.
The Kelly criterion drops your leverage instantly. The model pulls you out of the market and puts you in cash long before the full wealth-destroying bear market takes hold in 2001 and 2002. It acts as an early warning system. It catches the structural decay in the hidden state before the devastating price collapse fully materializes on the surface.
Okay, but that 0.0% transition probability from bull to bear is the exact kind of neat, mathematically courteous pattern that quantitative analysts love and that actual markets violently, ruthlessly punish.
It's what the data shows.
You are looking at a mathematical artifact and treating it as a law of physics. It is a statistical illusion created by smoothing a specific 15-year data set. It is not a law of nature.
It's a robust probabilistic measure.
You bring up the dot-com unwind, which was indeed a slow-motion train wreck. It fits your narrative perfectly because the psychology of that specific bubble took years to deflate. But let's talk about the reality gap.
The reality gap.
Let's talk about what happens when the market refuses to step into your polite waiting room. Let's talk about Black Monday, October 19, 1987.
That's a true outlier event.
An outlier event that destroys funds. The Friday before Black Monday was nervous, certainly, but it was not a recognized systemic collapse. Over the weekend, anxiety compounded. Portfolio insurance models, the quantitative darlings of their era, designed to dynamically hedge risk, all aligned in the same direction.
Yes, they cascaded.
When the opening bell rang on Monday morning, the market did not politely excuse itself and step into a flat regime so investors could gracefully de-risk. It gapped.
Liquidity dried up, yes.
Liquidity evaporated instantly. The specialist system on the floor of the exchange broke down. The Dow Jones Industrial Average fell 22.6% in a single trading session. Let me reiterate that. 22.6% wiped out in hours.
I acknowledge the severity of 1987.
The market plunged directly from a state of manageable concern straight into the abyss. There was no transition matrix that could save you. If you were holding leverage because your model told you the bull regime was active on Friday, you were bankrupt by Monday afternoon.
But those events are incredibly rare.
And history is replete with these exogenous shocks. These are the moments that define generational wealth destruction. Consider the 1973 oil crisis. The geopolitical landscape fractured. OPEC initiated an embargo, and the global economy was instantly repriced. There was no mathematical decay of momentum. It was an immediate structural shock.
Geopolitics are hard to model.
Consider the sudden, terrifying destabilization of the 1979 Iranian Revolution. Or look at more recent history. Look at the immediate sell-off in early 2020. The market was pushing all-time highs in mid-February. The bull regime was completely dominant.
And then COVID hit.
Then, the reality of the COVID pandemic froze global commerce overnight. Entire sectors of the economy were ordered to shut down over a weekend. The market gapped down limit after limit.
It was an unprecedented biological event.
Or examine the Russian invasion of Ukraine on February 24, 2022. The S&P 500 dropped 2.5% in a single day, after a period of already deteriorating sentiment, blowing through any measured transition phases. Reality reserves the right to gap.
Right, but you can't abandon modeling entirely just because of gap risk.
The physical world does not care about your Markov chains. If a risk engine behaves as though the market is contractually obligated to honor a 0.0% transition probability from bull to bear, the market will eventually, inevitably, destroy that portfolio.
You hedge against those gaps outside the model.
You cannot engineer away exogenous shock with a transition matrix fitted to a quiet decade of central bank intervention. When the geopolitical tectonic plates shift, the waiting room collapses entirely.
Look, I will concede that a literal fundamentalist interpretation of the model's hard labels is flawed.
Okay, well, that's something.
Blindly trusting the absolute binary classification, believing that a state labeled bull can never under any circumstances gap directly to a state labeled bear, is indeed a dangerous way to run institutional capital. The taxonomy of the states is a heuristic. It's not an infallible prophecy.
Glad we agree on that.
However, where the framework redeems itself and where sophisticated quantitative practitioners actually find the true durable edge is in moving away from these hard labels. You do not use the model as a rigid traffic light. You use it as a fluid gauge.
A fluid gauge? Explain that.
The solution to the reality gap is weighting the Kelly criterion by posterior probabilities. In a Bayesian framework, you are never 100% certain of anything. The hidden Markov model constantly recalculates the probability that it is in a given state.
Right. The probabilities shift day by day?
Exactly. You don't wait for the model to officially declare a definitive shift from bull to flat. You don't wait for the label to change. Instead, you monitor the shifting probabilities beneath the surface. Imagine the model starts the month with 98% confidence that we are in the bull regime.
Okay.
Over the next 2 weeks, price action becomes erratic. Volatility spikes slightly. The model recalculates. Its confidence in the bull state declines from 98% down to 80%. Simultaneously, the probability that we are entering the flat state rises from 2% to 20%.
So the math starts recognizing the decay.
Because your position sizing is mathematically tethered to these posterior probabilities, your leverage is dynamically scaled down. Your position size smoothly and proportionally falls as the certainty degrades.
You're de-risking gradually.
You are peeling off risk long before your net exposure violently flips from long to short. The model provides a dynamic gradient of risk. It creates a continuous, highly sensitive warning zone that begins reducing your footprint in the market at the first mathematical sign of structural decay.
You know, on that specific operational mechanism, we actually find a rare point of agreement.
Really? I thought you were entirely opposed to the framework.
When the regime framework is stripped of its hubris, when it abandons the pretense of being an omniscient crystal ball, it reveals its actual utility. The model fails completely as a prophecy, but it can succeed, quite brilliantly, as a thermostat.
A thermostat. I like that analogy.
If we look at the flat state purely operationally, it fundamentally redefines how a manager should behave. We know the math of the flat state. A negative 10.7% annualized drift coupled with an elevated 21.9% volatility.
The waiting room.
Right. When the posterior probabilities begin heavily weighting toward this environment, it's not a contrarian signal to suddenly initiate aggressive, highly leveraged short positions. Shorting a high volatility, choppy market is notoriously difficult and capital intensive.
It whipsaws you.
Exactly. Instead, the flat state is a strict, unambiguous de-risking mandate. The Gaussian assumptions of the model are too flawed to trust. The Kelly multipliers are too structurally volatile to rely on for directional scaling in extreme states.
We agree that raw Kelly at the tails is dangerous.
Applying maximum leverage at the tails is suicidal. But the detection of rising entropy, the mathematical recognition that the market is shifting into the flat state, is highly useful if it forces a manager to take their foot off the accelerator.
It pulls you back from the edge.
The true value of the hidden Markov model is not in the precision of the new position it recommends. The value is entirely in the mathematical abandonment of the old position. It breaks the manager's psychological attachment to a trend that is quietly dying.
This realization is the intellectual climax of the entire regime detection philosophy, honestly. We spend so much time debating the extreme outputs, the 29x leverage, the violent short positions.
Because they're sensational.
They are. But the most valuable signal generated by these complex, mathematically dense models is not a binary command to buy or sell. The most valuable signal, the true alpha generated by the framework, is simply the objective realization. Your edge is decaying. Cut size now.
Exactly. Shrink the footprint.
When we look back at the phenomenal backtest results I presented earlier, the 21.9% compound annual growth rate, the 1.68 Sharpe ratio, we have to look at how those returns were actually constructed.
It wasn't from timing the bottom perfectly.
No. The secret to the strategy's massive outperformance wasn't that it expertly caught the exact top of the market. It wasn't that it perfectly timed massive leveraged short positions down to the absolute bottom of the bear regime.
It was the cash position.
The true driver of the outperformance was the restraint of moving to cash during the flat regime. That unglamorous, inherently conservative shift to cash was the active risk management that preserved the capital base.
Preservation is key.
By stepping entirely aside during the transitionary deterioration, the portfolio avoided the choppy, sideways, high volatility whipsaws that destroy compounded returns. Capital preservation is the highest form of compounding.
That's a great way to put it.
The model proves that objectively identifying when you lack an edge is mathematically more lucrative than trying to force a trade in a hostile, rapidly decaying environment.
Which ultimately requires a complete demotion of the regime framework from the pedestal of a market oracle down to the utilitarian, unromantic role of a disciplined risk thermostat.
I'm comfortable with that demotion.
The success of the model is absolutely not about proving that these three hidden states, bull, flat, bear, are an objective, physical reality of the market ecosystem. The market does not know it is in a Markov state.
It doesn't.
Success is utilizing the mathematical output to prevent the portfolio from becoming dangerously overconfident in its historical edge. It is an algorithmic humility engine.
Algorithmic humility, yes.
This is why any practical application of these frameworks must discard the raw optimizer outputs. You cannot blindly follow the math. You must use fractional Kelly, perhaps risking only a quarter or a tenth of what the formula demands, to cushion against the inevitable estimation errors.
That's standard practice at any serious fund.
You must implement hard, immovable leverage caps that override the mathematical outputs, ensuring that even if the model screams for 29x leverage, the portfolio never exceeds a conservative threshold.
Agreed.
And most importantly, you must possess independent, exogenous crash overrides that sit entirely outside the Markov logic. You need protective put options, you need structural tail risk hedges to protect against the gap risks and black swan events the model fundamentally refuses to acknowledge.
You have to protect against the 0.0% transition actually happening.
Yes. But as we conclude this analysis, this leaves us with a lingering, critical question as we move forward into the next decade of quantitative finance.
What's that?
We are entering an era of unprecedented computational power. Machine learning algorithms are analyzing tick-level data in nanoseconds. As computation scales and AI-driven high-frequency regime detection becomes ubiquitous across the entire industry, will this technology democratize disciplined risk management for everyone?
Will it make markets safer?
Exactly. Will it make the market safer by forcing everyone to rationally de-risk during the flat states? Or will it simply create new, highly leveraged, catastrophically crowded trades?
The portfolio insurance problem all over again.
Right. If thousands of identical multi-manager pods and AI-driven models all detect the exact same transitionary decay, and they all attempt to de-risk and dump their exposure at the exact same millisecond, will they become the exogenous shock? Will the proliferation of the models make the next inevitable gap even more violent than 1987?
This is the Research Desk officially signing off.